Well, here we go again. The Federal Reserve just raised the federal funds rate target for the third time this year. And now that it has happened, how might it affect your investments? Certified financial planner Paul Fain joins us now with 5 things to keep in mind. Now, Paul, first off, just refresh us what the federal funds rate is.
Well, Leslie, the Federal Reserve helps influence the money supply in our economy, so they can do things like change key interest rates. So the Fed funds rate, the federal funds rate, is a rate that they set that banks charge each other to borrow money. So they can increase the money supply by lowering rates. They can decrease it by raising rates. And again, it's either putting a little foot on the gas or tapping on the brakes when they raise rates, just to try to keep economic growth on a healthy level.
Now, for people's savings through investments, how is that change going to affect those?
Well, that's the question, isn't it? So with short-term interest rates, think about certificates of deposit, savings, banking, short-term bonds, short-term bond funds. You see these higher rates start to trickle through a little quicker. With intermediate term, long-term bonds, for example, say we're going out 5, 10 years or longer, we may not necessarily see much trickle through in this rate increase.
And obviously if it changes 3 times a year, something long-term. Now, what about people who have a house or maybe have rental properties that mortgage?
Right, because that's where most people's minds go quickly. When rates go up, how's it going to affect my borrowing? Well, if you've got an adjustable rate mortgage, an ARM, you'll see a change. When the interest rate next resets, it's going to be resetting at a higher rate within the structure of your loan. Fixed rate mortgages typically are tied to the 10-year Treasury note rate, so and might not necessarily see many changes in the 30-year mortgage rate.
Wow. Now, people that might. Quick question I saw about the fixed mortgages. Is it better for someone who might be thinking about buying a house going for that, knowing that this has changed 3 times in this year? Yeah,
because the Federal Reserve has indicated that there's several rate increases still ahead, and we hope there is because we hope the economy's growing. If you've got an adjustable rate mortgage, you might look at refinancing to a fixed rate mortgage. If you're going to be looking for a home anytime soon, go get pre-qualified, get all the ducks in a row, right?
Yeah, definitely. Now the stock market, finally, people who like to play that, how is that going to affect them?
Right. Well, typically, when the stock market's in the early stages of experiencing rate increases, it's a pretty good bellwether for the stock market. I'm an armchair economist, right? So I would say we're probably mid-cycle in this rate increase. When interest rates, short-term rates and long-term rates normally are like this. Right now they're kind of flat. If the long-term rates go below short-term rates, that's usually an indicator that we're getting closer to a recession. But our final point is these cycles take place and they repeat, rinse and repeat, right? So we think it's important to diversify, occasionally rebalance, try to stay true to your risk tolerance and your time frame for when you're going to need this money.
Yeah, definitely. Thank you so much, Paul. We appreciate it.
Good to see y'all.
We'll send things out to Cass.